The right retirement planning strategy can mean the difference between a stable retirement and one marked by financial stress. If you're already retired, careful tax planning can help preserve what you've built. Hi, I'm Matt D'Amico with Networth Advisors. Today, I want to take some time and walk you through a few tax tips that every retiree and pre-retiree needs to know. If you're like most retirees, you probably have multiple investment accounts. Maybe a 401k or IRA, maybe a Roth IRA, or maybe even a non-IRA like a brokerage account. And so you have these different buckets of money, with the obvious next question being, where do you take your income from? And so a key part of successful retirement planning is making strategic decisions about the order in which you withdraw money from these accounts. This alone can have a big impact on the longevity of your money. How to plan for those required minimum distributions. The year that you turn 73 or 75, depending on the year you were born, you must withdraw a certain amount from those tax-deferred retirement accounts each and every year. And if you don't, you could owe major penalties. These are known as RMDs and are actually taxed as ordinary income. And there's a chance that they could push you up into a higher tax bracket. If that's a concern for you, you might consider some tax strategies like a qualified charitable distribution, maybe some Roth conversions, or other tax planning ideas to reduce how much of your money goes to the government, keeping more for you and your family. Lastly, I want to touch on some retirement benefits that retirees have and how they might be affected. For example, many people think that Social Security is tax-free income. However, if your income exceeds a certain threshold, you could owe taxes on up to 85% of those Social Security benefits. For 2026, that threshold is $25,000 if you're a single filer and $34,000 if you're a married couple. Another benefit that may be changed is your Medicare premiums. If you have high income in retirement, you might have to end up paying more for those Medicare premiums. This surcharge is called the Income-Related Monthly Adjustment Amount, also known as IRMAA. And this has what's called a 2-year lookback. So for example, in 2026, you may have to pay more of those IRMAA premiums if your modified adjusted gross income for 2024 is more than $109,000 if you're single, or more than $218,000 if you're married filing joint. Now, these tax tips are really just a starting point. Each person's retirement planning strategy is unique, and personalized guidance can make a major difference. And that's why we're here. To schedule a conversation, call us at 724-746-3585 or email us at schedule@networthadvisorsllc.com. Thanks for watching, and don't forget to like and subscribe.